Mode.
Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading weekend in October 20th, 2017. Man, market mania or market madness? What is it? Well, depending on who you talk to, some will say it's mania. Just keep buying and buying and buying, and others would probably say it's market madness, where eventually everything is going to come home to roost and you're going to end up losing a lot of money. I, however, have been saying all year long, we're in a buy the dip mode. I mean, think about it this way. Globally, we're all synchronized towards global growth right now. We haven't had this in quite some time. Earnings are very solid. So far in this Q3 earnings period, I think about 70% of the companies that have reported so far, I think around 90, have sales that are much better than estimates. 72% have better earnings per share and or better reported sales. That's higher than the long-term average of 59%. I always like top line number because you can't re-engineer sales. You can engineer bottom line earnings per share by share buybacks, taking float off the market or off the street. A lot of things you can do to engineer that. But you cannot engineer new sales, and we're topping out in this by 12 13% higher than average. So we're getting strong corporate growth. We've got low inflation still. We've got low interest rates, although the Feds right now, the probability of a Fed rate hike in December, I think they're meeting on December 12th and 13th. 13th would be the date. There's about an 83.6, call it 84% probability of another quarter point rate hike. That would put us in the 1 to 1.25% range at their next FOMC meeting or their first one in December. So, but even having said all of that, the markets are just continuing to move higher. I've been a buy the dip all year long. Also on Friday, we saw the S&P break a record for the longest streak without a 3% decline. I think we moved to 242 days, 242 days without a 3% pullback. The last time we saw that was in the 90s, 95 through I think 96. It was like the markets moved 30.4%. Right now, the markets are up about almost 23% since November the 7th after Trump won the presidency. All of this comes on the Trump bump, the reinflation trade, which, by the way, we haven't seen, but the market's very positive. Also, we have a little bit more oomph in the tank, I believe, if they get these tax package cuts through. That could be good for another 100 to 200 points in the S&P. If they get the corporate tax rates down to 20%, I've seen various analysts analysis from Goldman and several other investment firms as far as what it could do to earnings per share. So we're getting those kind of things moving. And of course, the Dow right now is leading the way. Keep in mind, though, the Dow, it's got its own little peculiarities. Most of the indexes are weighted by their market cap, but in the Dow, it's weighted by the share price. So you've got companies in the Dow that have really high share prices like Boeing or McDonald's, Goldman, Visa. They have a very high share price relative to other stocks in the Dow, so they tend to move the Dow a good bit more than, say, GE, which is not doing very well, but they have a low share price. So that's kind of helping the Dow a little bit. But outside of all of that, we're still moving very, very strong to the upside. Any dip, I still remain a buyer on the dip. And if you look at what you'll see here on the screen right here is the S&P 500 E-mini futures. And I know I still have a lot of friends that have just been, talk about a painful bull market. A lot of my friends in the hedge fund and trading world are telling me, Brent, the market's going to pull back. They're going to pull back and then they're going to crash. And eventually they're going to be right. Right now, though, I think near term, we're still skewed to the upside. You can see this channel, which goes to the entire year. It's got about a 45-degree vector to the upside. Anytime we've fallen below this channel, we find very quick support and then a move back into the channel again. Okay, so you'll see here on the left-hand side of the screen, these blue bars, it's volume over price. We're up in a kind of a nosebleed territory here. Again, I don't, we still have another 300 companies or so, 350 companies left in earnings. This coming week, we're going to start to get some big tech stocks. And they may not perform as strong as the markets would like to see them perform based on their forward PE multiples. But either way, the markets still just want to bear higher. I mean, we're at all these all-time highs. Now, this is a daily chart, so we made all-time highs on Friday with the S&P. If you look at the Dow, look at the Dow here, we're at all-time highs here on the Dow. And 2017 highs, by the way. If we look at the Russell is the only one that, and we're moving back up, but this little dip here in the Russell, for our members, we took out a short trade in the Russell, and we've made some nice money on this little bit of a dip. But again, it's a buy the dip moment. It's not a sell the rally moment. We're still in a buy the dip on this environment. So we did the same thing with the RUT, but we're still near all-time highs in the Russell, 2017 highs as well. And then, of course, if you look at Nasdaq, which is heavily weighted towards technology, it's starting to run in a little bit of resistance, but we're still near all-time highs. Okay. And then if we go international and look at Vanguard's all-world index, we're near the 2017 highs, or the all-time highs for this all-world index. It hadn't been around for a longer period of time, but if I just kind of pull it back a little bit, you can see here, I mean, we're at the all-time highs on this index here. So again, synchronized global growth is just money is going everywhere, and money just cannot get enough. I think part of the reason is we've got such low government bond yields and treasuries all over the world that there's no place to go but the equity market. So is it creating some asset bubbles? Yeah. Will we have a pretty good little pullback? Yeah. Will it happen in the next 30 to 90 days before the end of the year? I don't think the odds favor that. I think the odds favor Yellen to come in December and price in another 25 basis point rate hike in the U.S. But keep in mind, that's already about 80% factored into these current prices and yields so far. So that's not going to undo anything. They expect Yellen to stay relatively dovish. Speaking of Yellen, she's going to be out of a job next February unless Trump reappoints her. But his two other favorite picks is Powell, who is a Yellen clone. He's also very dovish, and he's on the Fed Board of Governors already. And then Taylor, who's a little bit more hawkish, but they're both come highly recommended. And I think Powell would probably be the pick outside of Janet Yellen keeping her job. I think Powell would be the least disruptive. And remember, Trump needs to appoint a Fed chair and a vice chair because he's also retiring, Fisher. So that means that he could put in Powell and Taylor, so it'd be kind of like good cop, bad cop. And I think it'd be a pretty good balance, counterbalance to each other. The dovish being the Fed chair, the new would be Powell, and then the hawkish being the vice chair, that would be Taylor. Now, he could surprise everybody and leave Yellen in and then put Taylor in as the vice chair. I don't know if that's going to happen. I think he wants a Republican in there, but he would be well served in this regard. So either that, be that as it may, the markets view that as a bullish sign, so that takes some of that risk off the table. But you can see the all-world index is up very high, and then if we look at Asher, which is a tracking stock for China, China is near their 2017 highs as well. And they're going through their once every 5-year meeting with their head honchos there. And they're not going to have anything happen to undermine the market as they go through that. So China is doing good. So on all fronts, folks, the markets are just, they're just, all full steam speed ahead. Again, I think we're going to be in for a nice little dip or a pullback. Remember, I define a dip as less than a 5% move to the downside. I define a pullback as 5 to 10%, a correction greater than 10%, and a bear market greater than 20%. That's how I define them. Now, the market has agreed upon acceptable norms for a bear market. That's a 20% pullback, and a correction, which is 10%. But out under that, they don't have agreed acceptable norms. So I've come up with the Brent special. A dip and a pullback. So a dip is just what it is, less than 5%. And I see a dip happening sometime in the next 90 to 120 days. So that's kind of where we're sitting here. That would be less than a 5% pullback. I don't see it happening going into the end of the year, short of any geopolitical event like problems with North Korea, or if this issue in Spain gets way out of control and you have the TV screen splash with Granny getting thrown to the curb with her groceries in her arm by the military from Spain, as they try and come in and restore order if the Catalan president insists on going through this independence move. But right now the markets are taking it in stride. There's not much going on there. And of course, if we look at the bond market had a pretty good little down day, over one full handle and 14 ticks. You can see here it's trying to move up, but as I said last week, any move up here is probably going to be sold off. But we're in this very strong support area right here, and keep in mind this current price of bonds is going to stay around this area because of the central bank stimulus all over the world right now. Even though the US is not doing stimulus, even though Yellen is talking about starting this coming month, reducing the Fed balance sheet, okay, you still have Japan, China, Europe, Great Britain, all pumping money into the markets. So it keeps their government bonds and debt very cheap interest rate wise. So where do you think a lot of that money goes? It probably comes into the US Treasury, US bonds, US 10-year notes, and so forth. So that has flattened our yield curve, and kept the longer term rates low, but the short term rates are moving up just because they're more sensitive to what Yellen is talking about. So net, what that really means is I don't think bonds are going to go much lower than this for the time being. When next week we've got Super Mario Draghi on Thursday coming out with his pronouncements on what he wants to do with monetary policy, and if he starts to lighten the load and start to be a little bit more hawkish, then you'll see the bonds here fall even further, okay, because money will come out back to Europe, into other higher risk type asset classes. So that's where we're sitting on the bond market. The dollar had a really strong day on Friday. You can see here we're now challenging this down sloping trend line again, or this channel that we've been in since the beginning of the year. If we break out of this and we break out of the 94 area, I think the dollar is going to run up to the 95.7 area, which means the euro is going to continue to pull back. Remember what I said. I said the euro is probably going to pull back to around $1.16, and we started that back in this area here. Once we broke this upsloping channel, we almost came down to my target. Not quite. We hit about a 117 roughly. I think it can come back a little bit weaker. We're trying to clear this 50 EMA, but we're having trouble doing it. Every time we've closed above the 50 EMA, the next day it's moved back below. This has happened 2 times. That we've tried to clear above it since the beginning of October. So the past 3 weeks, every time we tried to get above the 50 EMA, the market forces have pushed it back. But there's this upward lift in the market because most market participants believe at some point Super Mario is going to have to come in and remove the stimulus from the ECB. And that'll put a little bit of an upward cant to the euro. So, and it's a very difficult trade right now. I've said it's going to be choppy, sideways chop, but I do believe the euro has a little bit more further to come to the downside, the dollar more to the upside. Now for the British pound, as I've been saying, this is a great trade long term. You can see the channel, not quite a 45-degree vector, probably about a 38 to 35% degree vector to the upside. And you can see how wide the channel is here from the upper of the channel to the bottom of the channel. And we got overextended to the upside here. And now we're sitting on the 50 EMA, almost just slightly in the center of the channel, but we're still maintaining this upward vector. I think this is going to stay like this for a while. We may move a little bit lower, but then I think buyers are going to step in. Longer term, I think the pound's going to work its way back up to $1.40. And that's kind of where I'm playing this longer term in the British pound. The yen is going to be interesting to see how the yen plays out. The reason why I say that, the yen is a place of safety. When the markets seek global safety or global comfort, global Novocaine, they go into the yen. and then they rub it all over them and they lose the feeling of pain. But when the yen starts going down, that means money is flowing into the equities. The yen moves just the opposite of the Nikkei. And at the Nikkei, and is, let me just find it here. You can see the Nikkei is, already at 2017 highs, right? I mean, we closed at 2017 highs. Now, it has been in a bear market for like 28 years. Unbelievable. If I were to put this on a weekly chart, you can see where the Nikkei has been. Let's just go way back in time. I don't even know if I have it on the futures market. No, I don't have it on the futures market. But it was much, much higher than this. But you can see right here, we're making highs that we haven't seen for quite some time. And the Nikkei usually moves the opposite of the yen. So as the yen gets weaker, it's going to put upward thrust in this. So everything is, all lights are green. And then, of course, if we look at volatility, what can I say? It closed the week at 9.97. You can see a little bit of chop here, but every single dip has been bought. Now, eventually, this is not going to stay like this. It is going to continue to bounce around here, and then we're going to get a huge spike to the upward direction. I don't know what's going to cause it. Can never know. But you want to look at long volatility strategies either way. And for our members, we're looking at long volatility strategies, whether you have a portfolio margin account or a T-Reg account. Portfolio margin gives you a lot more flexibility to come up with some longer term downside hedges than say a Reg T account, but they're still there nonetheless. And then of course, if we look at metals, if we look at gold, down a little bit, all right. I still believe longer term gold is going to move higher. Near term, I said it's got to clear. When it was pulling back here, I said 1300 is going to be the area. And you could see it bounced around here a couple of times and it tried to regain it, but it could not hold it. And now we're sandwiched between the 50 and the 200 EMA. Gold, by the way, guys, is a very technical trade. It tends to follow the charts much closer than others because it has no value other than perceived value of the buyer. And as a hedge ratio against inflation and fear. There is no inflation, so the only reason why people are buying gold now is just a store of value against devaluation of the dollar or inflation and fear, but mostly fear right now. And as the markets are just not really fearing anything, it doesn't surprise me that gold is a little bit weaker. I think longer term gold is going to move higher. Shorter term, it's just in a chop. All right. And if we look at silver, it's the same thing. For our members, we're trading silver and we just got into gold using some a combination of straddles and stock in a form of gamma scalping, which I'm sure a lot of you will find very interesting. By the way, our option masters is going to be kicking off, if not this Thursday, then next Thursday. So in this email, go look below. You definitely want to sign up for it because I'm going to go into how you can use gamma scalping to control your risk and manage these trades a lot more effectively. And if you got a portfolio margin account, it's definitely something you want to look at. So anyway, but you can also in a non-PM account do it as well, like we're doing in silver. So this is where we're sitting with silver right now. We're testing this downsloping trend line right here. So we're at a key break point around the 1690 area. And you can see the volume over price right here as well. So that's a little bit about what we're sitting on. And then oil, you can see oil is sitting, I said before, oil is going to have a hard time breaking this upward area here. We had a changing of the guard. We had oil futures rolling over to the DEES contract month. So it tends to create a lot of chop in the oil markets when we do this, but there's a lot of conflicting forces around oil right now, both bullish and bearish, and it's keeping us in a wider range chop. So we're now trading, we've still been trading oil for a year now. We've had successful trades. We'll continue to move forward with our oil trades. In fact, when we start our option masters, I'm starting a separate oil portfolio trade where we'll trade only oil in different portfolio sizes, so everybody will be able to participate in that in our secret trader if you're in that group. So that's where we're sitting with oil. And then we've got some things I'll be looking at in agriculture and possibly meats or softs. So that's where we're sitting as we go into this week ending October 20th. Next week, we're going to get some really good tech stocks. It's going to start to belly up to the bar, and in the next couple of weeks we're going to get the bulk of earnings come through, so we're going to see how this all plays out. But again, I'm still a buy on the dip unless or until we take out key pivot points. That's the way we're going to play the markets. Everybody have a great weekend, and members, I'll see you this Sunday night in our weekly market watch at 8 p.m. New York City time. Ciao, everybody.